Please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Well, it's been a good recovery for the markets. The mid-cap index is now in the green, and even the Nifty has recovered quite a bit from its lows. It's now back above that 11,426 level. Remember at one point in time, look at that move that we've seen just in the last 10-15 minutes or so. Let's talk about the currencies and the commodities. Let's find out if there's been any recovery there at all. Manisha Gupta is here to give us a roundup of all of that. Hi, Manisha. Good morning.
Morning, Sonia. Thank you so much for that. Well, yes, there is some recovery, but I don't know how much you can really read into that because the markets are still all over the place. We are looking at a lot of volatility and there is a lot of jitteriness in the global markets, and that is where the commodities and currencies are taking cues from as well. Starting with the crude oil prices, and we did see 3% of a decline in the overnight market. It is trading 0.25% on the higher side in the global markets right now for the Brent prices, but we haven't seen any recovery in the Indian markets there. Very sharp declines is what we are looking at. The reaction also comes in on the back of the fact that yesterday our markets were not working, so we also are reacting to overall changes that we saw in the international markets yesterday. So the crude oil prices, of course, are dealing with the OECD volume growth peaking out. There is weak demand eating out of Asia and China. The Chinese imports have continued to decline. The Japan imports are lowest in many years, and you also have seen increase in US production. The US inventories have gained by 6.8 million barrels, and markets weren't really expecting that huge number, and that is what has brought in bearishness to all of those prices. One thing to watch forward really is that the US and China are set for trade talks. Beijing has said that they are sending a delegation to the US by the end of August, and that really seems like one positive thing in all of that we are tracking into the global markets there. But very sharp declines on your screens, and 3% down is how the US crude oil prices are trading on your screens right now. The strength in US dollar trading at a 13-month highs has led to a constant pressure in case of precious metal prices. So we are looking at the gold prices trading at a 19-month lows, 1.5% of decline onto that one, and silver clearly following the other industrial commodities which are down anywhere between 2 to 5%. So a big 3.5% of a decline coming in there. 36,500 is what we are holding, just about holding actually for the silver prices there. The base metal prices also have seen very sharp cuts coming in. It's a third straight day of decline there. 3% down in copper, and that's a one-year low. And copper is now into a bear territory where we have seen the prices decline by 23% from their 52-week highs. Aluminum, even as the fundamentals are strong, but with the kind of decline that we have seen in other metals, also seems to be bothering this space. The sharpest of declines, though, have come in for the steel ingredients, where you have nickel and zinc declining very sharply. So zinc is trading at a one-year lows. 4% of a decline is what we've seen come in Shanghai today. And LME declined by 4.5% yesterday. So we clearly are factoring that in. And pretty much the same scenario, as you can see, 3 to 4% of a cut is what we are looking at across metal prices there. Trading strategies, and a lot of impact really comes in from currency here, where we have seen the rupee decline by 0.5% today at an all-time low yet again. So it is yet again further declines anticipated there. Angel expects the futures to decline all the way up to 70.60. It's a sell call for gold, 29,400 of a target onto that one. And it's a sell continuing in case of metals, where copper prices can fall all the way to 408 in the day today.
All right, Manisha, thanks a lot for that. So back to our top story. The rupee is now at an all-time low. Ashima Goel, the member of the Prime Minister's Economic Advisory Council, joins us on the phone line. Ashima, good morning, and thanks so much for joining us. Before I ask you your view on the rupee, I also wanted some thoughts on where the current account deficit could be headed, given the way the macros are shaping up. There are a lot of, experts indicating that by the end of this year, we could be at a 3% plus with respect to the current account deficit. Is that what your view is as well?
I think we've seen the worst is over on the current account deficit, because as you were just reporting, commodity prices have been softening, including oil, because of global bearishness. And these were really sharp in the recent period and are responsible for the current account deficit coming in high. So some rupee depreciation should help our exports that operate on competitive margins. So I think the current account deficit could be, less than 3, maybe 2.5% this year. And moreover, in the past periods of global shocks and rupee depreciation, we've seen that there have been outflows, but they've quickly resumed, and we've never had to dip into our reserves more than, say, $14 billion maybe in 2008. So we have adequate reserves to finance the current account deficit, even if there's some slowdown in foreign portfolio inflows. I think that going forward, things should be somewhat better.
Okay, so a current account deficit closer to 2.5% for this year. Ashima, good morning and thanks so much for joining in. What about the rupee? What, according to you, is the fair value of the Indian currency? And do you believe it's bottomed out close to the 70-71 mark?
Yes, I think so, because I did some work recently. And although the real effective exchange rate has appreciated over the last 3-4 years, I think the fair value of that read now is about 114.15, and with the rupee at between 70 and 71, we are at that level. So I think our exports are competitive at this rate, and a sustained appreciation, sustained over more than 2 years, is negative for export growth. And the last 3-4 years, we have seen that. So therefore, the current correction is healthy. In 2017, we saw too much of inflows and too much of appreciation pressure on the rupee. It actually appreciated steeply to 122, the real effective exchange rate. Current depreciation is actually bringing the rupee closer to fair value and doing it in a relatively painless way. And therefore, it's good for long-run export growth and to keep the rupee at the fair value. And markets do tend to overcorrect, but then, and this also we have seen in the past, but then they correct again towards what is general in India, what is the fair value. And in general, in India, we are seeing inflation is coming down, growth is going up. So all the emerging markets are under pressure, but funds will begin to discriminate between those that are relatively stronger.
Okay, Ashima, actually, we've got you on a bit of a weak line, so we're going to try and touch base with you yet again. But thank you for your thoughts. So that's Ashima Goel saying that, no, she's not too concerned about the current account deficit. The worst perhaps is over and it could end at 2.5% of GDP by the end of this year. By the way, the Nifty has recovered almost 60 points from the lows. We had hit a low of 11,376 and now we are back above that 11,430 mark. So let's do one thing. Let's take a short break. On the other side of the break, lots more on the markets. So do stay tuned in.
Welcome back. Flat on the benchmark indices, but there is a big intraday recovery and the mid-caps are now holding up in the green. Let's invite Cox & Kings onto the show. The company has reported a weak set of Q1 numbers. While the revenue growth was good, it closed about 14%. The margins and profits have come down significantly this quarter. Peter Kerkar, the group CEO of the company, joins in now. Peter, good morning and thanks so much for joining in. Let me straight away start with your margin performance. Were there any one-offs which impacted your margins, and what, according to you, will be the sustainable EBITDA the company could see in FY19?
See, I think that I just want to debunk the fact that our margins have declined. Actually, our EBITDA has grown from the last quarter at 339 crores to 389 crores. Where we've seen impact on the EBITDA, it has been actually the fact that our overseas operations are quite large. And when you do a revaluation of the debt in terms of the decline of the rupee, this then has to be accounted for in our P&L. And therefore, if you see, there's a 103 crore swing in the actual foreign exchange notional loss in the company. The company does not actually pay for this loss. It's just a book entry. And we are actually quite well hedged because all our foreign companies actually earn in dollars, euros, and pounds. And this does not really impact us. So this is not a cash loss. This is simply a translation or a notional loss based on the revaluation of our loan book, which has to be reflected in the P&L account. So if you see the underlying EBITDA, actually we've grown by 15% plus this year, which is, compared to the last quarter of 18, we were at 339 crores, and this quarter we are now at 389 crores. So we are still stating that we will continue to effectively go forward with a similar increase year on year. However, given the fluctuation of the rupee, we will continuously see this revaluation of our foreign currency loans into our P&L. But I re-emphasize that this is not a real cash loss. This is simply a book entry in terms of the revaluation of the loan, which you have to then translate into your P&L.
Sure. We got that. So 103 crore notional loss is what you've seen because of the forex moves. Peter, hi, good morning. Do you see generally any change in travel trends when the rupee depreciates? I mean, this is an all-time low. So should we expect any impact on the business going ahead?
See, we've actually had this, foreign currency impact over our business over multiple years. And if you also look at it, the pound was at 110 rupees at one point. Today it's closer to 88 to 90. So when we are looking at such volumes that we now generate every year, if you see our average growth rate over the last 18 years has been around 17% CAGR. So given the fact that we actually operate, our peak seasons are counter-cyclical to the rest of the world, in that we actually operate from March now to the 1st of July. And the fact that our growth rate has been so aggressive, we've managed to substantially marginalize these risk factors by just larger volumes. So when we were at 4,000 clients in the year 2000, that may have made an impact on our business. But today, when we're in the millions, our buying power substantially has increased, therefore mitigating the exchange fluctuations dramatically. And as a company, we anyways either hedge our foreign exchange risk or we charge the clients in pounds so that there's no material impact on our Indian business. On our foreign businesses, for people coming into India, which is about 10% of our total leisure business, this can only be a good result because India is now substantially better value than it was last year. So overall, I think we will not see a decline in demand. I think you will still see a growth rate in the market generally of between 8 to 10%. And Cox & Kings has always tried to beat the market growth by 100%. So we would be looking still at around 15% or so growth going forward in the outbound leisure sector.
Okay, industry growth at 8 to 10%, while Cox & Kings will see a 15% growth. If you could just give us some color on your hybrid business. How many hotels do you currently have? How many have you planned to add? What is the expected revenue from that in FY19? And is Airbnb hurting your hybrid industries, hybrid businesses prospects?
So that's a really good question, because I think the hybrid hotel model is unique, and it sort of is because it's such a social environment where people can access very high quality accommodation in city centers and at a very reasonable price. So you may be able to buy a bed in a shared room at 6 or 7 euros and then pay another, say 8 euros for breakfast and be right in the heart of the city. So we are pretty recession proof, and that is one of the strengths of our model. In fact, when things go bad, people who tend to go for the 4-star plus category actually sometimes trade down into our hotels. In terms of Airbnb, if you look at it, Airbnb may offer you a fantastic product, but as a client, you may be staying in a bedroom or a flat. You still have to go out of your environment to access the social, environment, the fun environment, the bars, etc. Whereas because of our young and trendy approach, we find that we are the perfect hotspot for the millennium market, where people don't have to go out of our properties to meet new people. They simply can be in that environment at our bars, at our billiard tables. We have lots of innovative things that live shows in our hotels. So that's why I think we will continue to buck the trend in terms of where Airbnb or any other competitor stands and ourselves. Given the fact that we have still seen over 75% occupancy in our hotels, and that's bed occupancy. So if you look at room occupancy, we're 90% plus. And if you just compare this to the market, it's a phenomenal achievement considering that we are 90% plus through the year, not in any peak season. And finally, in terms of the number of beds, we've added on over 40% beds in the last year, and we've still maintained above 75% bed occupancy ratio. So this is also a phenomenal achievement. By the end of 19, we are anticipating that we'll go from the 11,600 beds to 15,000 beds. Okay. So we're continuing this projected growth. And in terms of revenues, in terms of revenue mix, we're around 25% of our revenues as we stand.
All right, Peter, we'll leave it at that. All the best for the quarters to come. We hope more and more people continue to travel and enjoy all the, the leisure activities, etc. But for now, let's do one thing. Let's wind down Bazaar. It is absolutely flat, but we've pulled back a lot from the lows of the day. As we do that, we'll leave you with a quick snapshot of the important voices that we saw on the show today. Thanks for watching.
We will see interest rate defense being used if the rupee weakness continues.
If portfolio investment flows turn negative, well, the currency has to weaken.
The next big level will come in around 70.5 and then followed by 71.
I'm not in the least concerned about political risk in India.
As far as Nifty is concerned, we're dragged by corporate banks and Tata Motors.
Alumina prices seems to have firmed up in the market.